Okay, welcome everyone and thank you for joining today's Bloom Impact Investing webinar on the topic of investing in clean tech and clean energy with John O'Brien. I am Camille, the founder of Bloom Impact Investing, and it will be my pleasure to be your host today. Before we start, please allow me to acknowledge the First Nations people as the traditional owners of the land on which this meeting is taking place today, which for me is Meerjin, Brisbane. I recognize the country north and south of the Brisbane River as the home of both the Turrbal and Jagera nations. I pay deep respects to the elders past, present, and future. Welcome everyone. It is a pleasure to see so many familiar names and new names today. At Bloom, we are focusing on the impact money can have in the fight against climate change. We are on a mission to make impact investing and sustainable finance easy and accessible. Part of this mission is to offer educational opportunities like these webinars to propel the voices of impact investing and sustainable finance experts far and wide. Since early this year, we have hosted several webinars. We've talked about climate financial risk, how to measure impact, how to invest during the COVID-19 crisis, impact investing trends, natural capital, and the impact superannuation and sustainable banking can make. If you missed our previous webinars, they are now all available on YouTube. So the aim of these webinars is to bring a community of impact investors and agents of change together so that we can build a greener, more circular and inclusive economy. Because you see, at Bloom, we see a future where a carbon-free economy allows people and the planet to thrive. This event today is supported by Impact Group. Impact Queensland aims to bridge the gap between Queensland's social innovation and impact investing sectors. Their goal is a thriving impact investment sector that fuels the growth of ventures, solving real-world problems for future prosperity. Thank you for your support. Quick housekeeping. Please note this event is being recorded. The webinar will be made available to the attendees after the event via email and on our YouTube channel. Please also note that the information provided in this webinar will be general in nature only and does not constitute financial advice. The information has been prepared without taking into account your personal objectives, financial situations, or needs. So before acting on any information from this presentation, you should consider how appropriate the information is in regard to your objectives, financial situation, and needs. Now, please note this is a safe space, so you can ask any question throughout the event by typing in the chat. Feel free to indicate if you'd like me to ask John questions on your behalf. Otherwise, I will invite you to unmute yourself and we will keep 15 minutes at the end for Q&As. Today, we are diving into my favorite topic, investing in clean tech and clean energy, with one of the most highly regarded energy transition expert in Australia, John O'Brien. So why am I so passionate about this topic? Because according to the IPCC, in order to limit global warming to 1.5 degrees, the world needs to invest around $2.4 trillion annually in the energy system until 2035. John, you might have some more current numbers. In this context, we clearly see that understanding the energy transition and investing in climate solutions goes beyond preparing for an emerging economy, beyond creating tomorrow's jobs or growing our individual wallets. We might be talking about one way to do climate action at scale. But enough about my thoughts. Let me introduce you, John, so you can share my excitement. John joined Deloitte in 2018 with over 20 years experience in the Australian and Asian clean energy and clean technology sectors. He's a strategic advisor to industry, government, and investors on energy transition, decarbonisation, renewable energy, and the clean technology sector. John started his career in the oil and gas industry in Scotland and Syria, engineering roles in London and Adelaide before joining Origin Energy in operations and corporate development. In 2007, John established Australian Cleantech, a strategic and corporate advisory firm that led the development of the clean tech sector in Australia for 10 years. before it was really cool. John is widely published with his most recent book, Visions 20,100, being launched at the Paris COP21 climate conference in 2015. John, welcome, and thank you so much for being with us today. Now over to you.
Thanks, Camille, and a great introduction. Thank you. I'll just pull up my slides, and hopefully you can see those. Are they on your screen, Camille?
Yes.
There they are. Great. Okay, so I'm going to chat for 30 minutes or so, and please, jump in. Feel free to ask questions when we get to the end. Everything. I've lucky enough to have been around a long time, so I've seen all sorts of things that work and all sorts of things that don't. So I'm really happy to discuss things. Camille talked through my history. I think one of the because I'm old, people say, "Oh, tell me about your career history. How did you get to where you got to?" Because it's a really interesting place to be. And I think the answer is don't go on a linear path. And I ended up doing all sorts of things in different parts of the world. And the fact that I've done all those things is really interesting. And I bring all of those to what I do today. So around taking the different bits of the different parts of my career into helping transition the world, and we're doing some really interesting things in my current work, which I'll get to. What I do want to talk to you about, so we'll just touch on some investment drivers, energy transition more sort of broadly, clean tech investing and some of the stuff we're seeing there specifically, and a little bit on green recovery and what we're seeing through the impacts of COVID on the energy markets and how that may impact things going forward. So quite a broad range of topics, but hopefully they all vaguely sort of fit together somehow. So if we look at investment drivers to start with, and there are three drivers we're seeing really sort of globally, and this is and actually before I get there, maybe, so one of my 10 years working with Australian Cleantech was really working with the technology providers, the people who had great ideas, and trying to help shape some of those into great businesses, and many of them weren't great businesses. Just because it's a great idea, we used to run an accelerator program for clean tech companies, and the first session we'd have all the 30 companies together in a room, and it was they were all shortlisted because they had great technologies. And the first day we would say the two phrases were, one is no one cares about your technology. So a customer, an investor, no one cares about your technology. They want to care what it does and what they get from it. And a good technology is 20% of a good business. And for the people who've spent half their lives developing a really cool technology, that can be really disheartening. But it's true. It's around how do you build the technology. And so one of the really nice things now in terms of what we're seeing and the real uptake now it is cool. Clean tech is now cool. Thanks, Camille. And that we're starting to see those deployed. So after a long time of getting stuff ready to be deployed, it's now being deployed and on massive scale, as we're seeing. So technology is clearly one of the major drivers, and the fact that prices are dropping and continuing to drop massively. So the solar pricing is dropping through the floor and continuing to drop at maybe 20% a year out of the factory. Battery technology is dropping at a similar rate. There's some really good sort of year-on-year stats out of Bloomberg that you can see on that. So whereas 10 years ago, if you wanted to become carbon neutral or be green, it was going to cost you money. Today, it actually can save you money. And we've done a lot of work for big industrials and big mining companies, and actually just corporates with sort of big roof space. And you can save a lot of money by switching to renewable energy. So that in some ways has made life a lot easier for companies and for people who want to decarbonize and to switch to clean technology. We'll come back a bit to technology a little bit later, but that's one of the major drivers. and so yeah, if you look at the pricing of where wind and solar it's right down there, and this is probably a year or so old now, from Lazard. And the other bit, there was a Deloitte report probably a year or so ago now, but it was on global renewable energy trends. You'll find it if you Google it. What I particularly like, I didn't write it, so but what I particularly liked about it was, obviously it told the story about costs and price parity, but also told the story of performance parity, and that renewables people are starting to work out how to do performance parity for renewables, and that actually, if done well, it increases grid reliability and grid resilience. So this goes against the sort of the common wisdom of you know, that renewables are unreliable. You can't, you know, the sun doesn't shine, the wind doesn't blow, everything falls over. If you actually build an integrated grid, and there's this is an example of a project in Florida, where instead of building a gas-fired power station, you can actually have a mix of renewables, some storage, but not actually that much, a lot of demand response, and that's a really critical area, and in my view is going to be the glue that sticks all of this together. So demand response will be being able to moderate demand, is going to be the thing that actually helps us get to very high renewable energy penetration, and energy efficiency as well. So actually by thinking a bit more broadly and a bit more carefully, interconnecting regions as well, and in Australia we're looking at sort of some major interconnections which will be very valuable. And you can build something that is more reliable, it has more diversity, and actually produces cheaper, more reliable energy. And I think this is where we'll be heading, and I think is fascinating. So in terms of that cost, it's still driving down, and the challenges of intermittency are starting to be solved. The second driver is policy, and the challenge with policy, and in all countries, but you know, especially in Australia maybe, is that you know, it comes and goes, and governments come and go, and you know, unless you happen to have a dictatorship, yeah, it's you know, you're going to have policy that changes, and there are pluses and minuses to dictatorships, but it's probably for another day. So you know, policy is there, and the Paris Climate Conference, as Camille said, I was there, just as proof. That was ended up being a very fun night in an Irish pub, but it sort of set the benchmark, and clearly there's been a lot of work that's happened since then, and governments are starting to move, and in Australia we are certainly at the state government level, we've actually seen quite a lot of recent action happening, but even actually if you look at the federal government, whilst you know, it's not, no one would say they're a massive supporter of climate action. If you look at the change of position over the last, say, 7 years since they came into government in 2013, where you know, really it was, you know, climate change almost doesn't exist, to at this very moment, you know, they're launching the low emission technology roadmap that maybe some people would like to see other technologies in, and being slightly different. But actually it's you know, and the conversation is, well, we're not going to commit to 2050 net zero, but we can probably do it. So that conversation has moved a huge way, and so you know, governments are all moving, but they may be not moving as fast as some people want them to, but they are moving, and they can move faster, and they're having the pressure on them of the community saying we want to move faster helps, because obviously politicians need votes, so if the community changes, they must change too. So the policy environment is there, and it is starting to really pick up, I think, particularly in Europe, where we're looking at sort of new Green Deal type stuff, and I think there's you know, Europe is a very diverse place, and you know, from but even recently, sort of with, you know, Poland was starting to talk about closing coal and looking at renewables, and so there's a big mix there, but it's, you know, Europe is driving stuff. And then the third driver, actually, I think is probably the most important, and this is what has changed certainly my world in the last 2 or 3 years. So the investor pressure on large companies has changed the story forever, and that the advantage of investors is that they don't have elections, so they don't go away after 3 or 4 years. They're in for the long haul, and they're demanding that their investments consider climate risk. And it sounds like you had a session on climate risk previously. And this started off with just sort of the activist investors, the sort of the impact investors who are, they're way out there, kind of, they're not mainstream at all. But it's come back, and it's across, the big. I've been on quite a few calls with the US over the last couple of weeks, talking about this, and the impact of BlackRock writing its letter, whenever that was, 9 months ago or more. Or was it the year before? I can't remember. But anyway, so BlackRock suddenly coming out and saying climate risk is one of our major concerns, and we expect every company to think about climate risk and tell us what those risks are, has changed the world forever. So investor pressure is a massive driver. We're working with some of the biggest oil and gas companies and the biggest mining companies and the biggest industrials, and they have, that is their major shareholder discussion is around climate risk, and what they're going to do about it. What are their targets? How are they going to meet those targets? And reporting on TCFD, the Task Force on Climate-Related Financial Disclosures. That's changed things in a couple of ways. So the conversation with companies is now not with the sustainability manager, it's actually with the CFO, the CEO, and the board. The sustainability manager has to do all the work, but actually the people who care are the people who run the finances and run the company. So that's changed everything. It's also changed, it's continuing to change, and it's changing very, very quickly. So what companies are now finding is not only do they have their own investors kind of putting pressure on them, but their customers' investors. So if they're selling to other large companies, are starting to have pressure on, and then that's starting to come back through the supply chain. So they want to reduce starting to sort of think about scope 3 emissions. So they need to have carbon neutral or lower carbon products going into their as their inputs, and that's driving back through the supply chain. So that investor pressure, I think, is probably the biggest driver of everything. Some stuff on TCFD, which I'll jump over. So all three of them. And what it kind of ends up having for companies anyway is really this, it becomes, there is no option other than to find solutions, and that's where the Cleantech solutions come in. Yeah, so it's kind of, there's a whole lot of things there which I'll probably just jump over. So what we're then finding is with companies, and again, this is kind of all leading up to why the demand for Cleantech is coming and has arrived, and having spent a long time in kind of thinking about it. This is the journey we're working with for large companies on their road to decarbonisation. So they get investor pressure, and they need to do something. So and it's not entirely a linear journey, but we've kind of built this up with a number of very large companies on their global strategies. But it's actually understanding where emissions are going forward, understanding their climate risk, and kind of going back to the BlackRock comment. It seems quite reasonable if you're going to invest $1 billion in a company that you want to understand what risk comes with that. And climate risks are, until quite recently, were seen as something down the road. We don't have to worry too much about it. But if you look at both physical risks, so we are definitely seeing the impacts of changing climate on weather patterns, the fires in California, the fires here last year, and all sorts of other extreme weather events are clearly being increased, and the impact on supply chains, on operations, is starting to impact. So actually understanding that physical risk, but probably more in the front of mind anyway for companies is the transition risk. So if they're the last person to own a coal mine, the coal mine's not going to be worth very much, so you want to get out pretty quick, so you don't lose money. So it's actually making sure that you're, as the world changes, you're changing with it. There is, I can't quite remember where it came from. There's a wonderful quote somewhere around, it's not necessary to change. It's only if you want to survive that you might want to consider that. So it's the same with governments who don't change, and it's the same with companies who don't change. If you don't evolve with the world, that's okay. It's just you won't survive. So understanding that climate risk is is really a major focus for large corporations at the moment. Then making targets and understanding what your abatement pathways are and how to align that with science. So are you going to align with the Paris Agreement, 1.5 degrees, whatever you might be saying, you actually have to justify through the science. You then look at your operational emissions, your scope 1 and scope 2, and how can you start decreasing operations within the business, and that comes to sort of renewable energy, but also energy efficiency and sort of smart grids and things like that. You're looking at scope 3 for value chain partnerships, and then communications and actually sort of doing the projects. And a lot of this, so kind of a lot of the stuff I'm talking about is around carbon and energy. And the conversation is also within companies starting to be a little bit more holistic across sustainability. So, you know, we're starting to have conversations around what's the least cost water reduction pathways, what's the least cost waste reduction pathways. So it's, you know, Cleantech, you know, there's various definitions. I'll show you one in a minute, but it's, you know, it is pretty broad. And whilst it is being driven at the moment now by carbon and therefore energy, it actually impacts a lot of other bits of Cleantech as well. So that was drivers. Energy transition, let's just sort of have a look a bit more generally at that. As I'm sure many of you on the call will know, you know, we used to have energy systems used to be beautifully linear. You had a power plant, you went down a power line and it got to your plug in your house, and it was all in a lovely straight line and it all flowed in one direction. And because of decarbonisation, but also decentralisation and digitization, it is now a far more complex, non-linear, interactive system, and we've only just started that journey. So it is going to get way more complicated, and that's why, you know, there are challenges in that transition. The grid was built for a completely different system, and what we're trying to do to it now is get it to work in ways it was never designed to, and that's challenging. And the grid companies have massive changes to make to how they operate, and their regulatory systems often don't necessarily allow for that innovation either. And then we're seeing sort of, you know, all the things on the right there around, you know, corporate PPAs, because companies want renewables. You know, everyone's got solar panels on their roof if they own their house. If they don't, if they own a house and don't have solar panels, then they're just silly. There's lots on hydrogen. I'm doing a lot of work on bioenergy for ARENA at the moment, and sizing that market. And then grids are just starting to, you know, we're just starting to see how that's really gonna pan out. So there is a huge amount happening in energy transition. And again, all the technologies that 10 years ago were, hey, I've got a bright idea about demand management, or, you know, how this might work, suddenly are desperately in need. And then the duck curve, as I'm sure many of you will have seen, is, you know, kind of how load patterns are changing through the day. You know, whereas there used to be a daytime peak, actually that's when all the solar panels are generating. So you actually have, it kind of flips around, and you get negative energy, negative priced energy during the day possibly, and the expensive energy is actually at night, which is, you know, a complete reversal of where it was. So business models and networks, again, you know, just everything's changing. What we're finding with the work we do with, you know, the incumbents, the people who've been there a long time, is they're just, in some ways, it's, you know, it's a shock of the change. I mean, it's been coming for a long time, but it's moved rapidly in the last few years. Is really, you know, but why our business model is not working anymore, and our assets are not working the way they should anymore, because, well, that's because they were designed in a different world, and with very different paradigms. So this sort of thing, you know, really is starting to make difference everywhere. Lots of companies going to corporate PPAs in terms of, you know, signing up for RE100 or other things. And this will continue to drive the demand for renewable energy. And we're obviously seeing that the pricing is continuing to come down, but some of the subsidies are falling off. But we will continue to see renewable energy driven into the market from this corporate action, and that comes back to the investor pressure. What that's going to do is interesting, and particularly when we come back to green recovery at the end, we're going to see coal-fired power plants forced out of the market earlier than you would otherwise think, certainly earlier than their design life, because the demand for renewable energy. And we're going to have to work out, how we balance that and firm that power. But it's going to make the coal-fired power plants less economic, so they're likely to retire earlier. Storage, obviously there's, again, this is probably a little bit old, there's all sorts of storage technologies, and it's not just about shiny lithium things. There are, this is a very simplistic version of a more complicated chart you'll find on Google Images, but there are a lot of different ways to store energy, and they all have their niches and when they are useful. Lithium is pretty good, and what it has had is massive scale up, so its pricing has come down, but there are lots of other storage technologies. So this will become increasingly important as penetration increases. This is really interesting. It actually comes from the Rocky Mountain Institute, and you won't really be able to read it so well, but go and have a look at it. It's about all the ways you can monetize energy storage. So instead of just sort of energy arbitrage, so buy it when it's cheap and sell it when it's expensive, that's really hard to make commercially stack up still in Australia if you're just doing energy arbitrage. So you need to get more value out of your battery, either whether it's in the home and you participate in a VPP and demand management trials, or the large batteries obviously operate in frequency regulation and other markets. But these are, I think it's 13 different ways that batteries add value. Not all are possible to be monetized yet, but that, as you're thinking about energy storage, thinking about different value streams is a really important thing to do. Demand response, again, this is probably this is a little bit old, but it's, as I said, this I think is going to be really, really important. Pretty much every load can be modified without causing damage. There are some things you can't do, but most loads can be modified and scaled back if needed. And my view would be in 10 years' time, we'll see certainly the majority of all grid power will have some sort of regulation on it, and will be participating in demand response. I reckon it's probably going to be 70 or 80%, just because that will be needed as we get to very high penetration renewables. Hydrogen is a very complex area. This is sort of a simplified version of hydrogen value chains, and there's lots of different routes, lots of different ways to produce the hydrogen, to transport and storage, and to utilize it. And the conversations, we've done a lot of work on hydrogen. We did all the modeling for the National Hydrogen Roadmap or strategy last year, and done lots of work in Japan on this. There's the economics of hydrogen are challenging. That where it is going to be of interest is it's going to enable hard to abate sectors to decarbonize. So initially, maybe that's where its growth areas are, where really hydrogen is as a chemical feedstock as opposed to an energy input. But that scale up will potentially enable some other uses for hydrogen. But it's obviously a lot of excitement in the market around hydrogen, and it'll get there. It's not going to happen quickly, in my view, but it will happen over time. And so the technology investment roadmap, so this was actually the consultation paper from 2 or 3 months ago, but as I said, it is being released as we speak. Looking around, and and it's not perfect, but actually it's not bad, and it's it does look around how do you decarbonize the electricity sector, and how do you decarbonize built environment and transport and agriculture. and what do you need to do about it now, and medium term and long term, and it's they certainly considered pretty much everything, which was great, and then looked at all sorts of technologies. The priority areas were interesting around electric vehicles. So we're in the middle of finalising the ARENA bioenergy roadmap. So know lots about that one, and I think I've got a slide somewhere on that. National hydrogen strategy with clearly that's already out there. The ISP is already out there. The waste policy to some extent is there, and critical minerals. So each of those is interesting. And then this is a poor screenshot from the Fin review this morning, but this was their stretch goals. So they've initially decided to focus on 5 areas and to set a stretch goal for each of those 5 areas. So they'd already announced H2 under 2, I think is the catchphrase, but $2 per kilogram hydrogen starts becoming commercial. It's a fair way from that price currently, so there is a long way to go. Electrolyzers out of China are starting to drop in price pretty rapidly, so that might be the way that is achieved, but there is a fair way to go on that. Long duration batteries, so that sort of comes back to thinking about different types of storage, and including things like pumped hydro. CCS is in there and will be heavily criticised, I'm sure, by many. My view on CCS, and I've done quite a lot of work on the economics of CCS, and it's nowhere near $20 a tonne currently. But my view is actually it's going to be needed. So it's not that historically it's been talked about as prolonging the life of coal-fired power stations, and the cost was all in the capture, not so much in the transport and storage.
Sorry to interrupt, for our viewers, CCS stands for?
Sorry, it's carbon capture and storage. So CO2 capture and storage. Where I think it will be needed going forward, and if you look at how do we decarbonize the whole economy, there are some industries that are going to really struggle, that we still need to probably going to operate for at least a transition period, and that will help decarbonize those industries more quickly. I also think we're going to end up needing to do drawdown, so we're actually going to have to start pulling CO2 out of the atmosphere, maybe post 2040, and CCS is a solution to that. I would have had CCUS, which is carbon capture, utilization and storage. So that then opens up, you don't just store it, but actually can you utilize it? Can you mineralize it? There was a company out of Canberra that's looking at sort of carbon mineralization. So there's some other ways you can do it without sort of necessarily putting it back into old gas reservoirs. People who are strongly environmental think CCS is terrible. I think it's not perfect by a very long way. I think and I think it'll be a necessary part of the solution for at least a little while as we try and decarbonize the whole economy. Green steel and green aluminium, I think, is interesting. That is, and the pricing there is, it's still a fair way to go on that. I've had some really interesting conversations with people who own an awful lot of iron ore, and suggested that unless green steel becomes commercial, we might not use steel anymore, and iron ore might be worthless, which is not necessarily a common view. And they go, but the world couldn't live without steel. It's not possible to have a world without steel. How do we build buildings? It's not possible. So in 10 or 15 years anyway, you'd think, 3D printed composites printed on site, would be, competitive on price and probably a lot easier to build with. So maybe steel doesn't need to be there. I'm not sure that's where we're going to end up, but it's a scenario that's possible. So making sure green steel works, and that's the driver for hydrogen, and one of the drivers for hydrogen in my mind. And soil carbon has been around, lots of talk over that for a very long time, 20 years. How we're not measuring, and the challenge is measurement and monitoring of that, and reducing the cost of that. And then everyone, largely the science agrees that there is massive potential there. It's just really hard to actually measure it, so therefore issue credits on it. But if we can crack that, that would be good. So yeah, there's some pretty good outcomes in there. There's some other things maybe I would have put in there as well, but it's not a bad start. So so where does energy transition end up? What's the energy future? So it's clearly underway. It's clearly unstoppable. So one interesting thought is, does energy become too cheap to meter? So abundant. So our solar production technology is so cheap, it's built into every building, on every car, on every house, on every road. Actually, it's just free. When I got my first mobile phone, which looked more like a brick than this sleek thing, you paid an awful lot of money for every call. Certainly, if you called international, gee, you'd have to mortgage the house. And now it's kind of unlimited. So does energy go the same way? Do we actually end up with unlimited energy? And that changes everything. If there's no energy, is just free. Go for it, which is fascinating. So increasing renewables, maybe we end up with a more efficient and more resilient grid. For years, people were saying we just need some policy certainty. There still are. There will never be policy certainty. So forget about it. Just move on and get busy with stuff. And then the opportunity is for industry to reduce costs and reduce risks and actually have a pathway where they might actually exist. So where are we on time? So I'll speed up the Cleantech index. So all of that is why there's this massive demand for Cleantech. One of the things I did a very long time ago, when I started my own business, so 2008, I launched the Australian Cleantech Index, and Deloitte now publish it, which is great. It's on the website. You can get it. You can download it once a quarter. It just looks at I think it's 91 currently stocks in there. The companies are spread across all different cleantech sectors, and there are, these are not perfect definitions, but this sort of largely gives a view. The companies need to have the majority of their revenue or forecast revenue coming from one of these sectors, and there's very different weightings across those sectors. So for a good period of the 12 years since I've been publishing it, it demonstrated why you should not invest in cleantech. I think there was 5 straight years where it just was how to lose money. There was a kind of a bubble at the beginning, 08, 09, and then it was just 5 years of just this is why you should not invest in cleantech. What we've seen in the last 5 years has been actually it has outperformed the market every year for 5 years. There's some. It's not a perfect correlation because it doesn't actually include dividends. It's just purely on the stock price. So there are some riders on that, but it has performed very strongly, and the different subsectors have also performed differently. So it's maybe a little hard to read. If you download the report, you'll be able to see it more clearly. The one that's dropping off there, which I introduced late, so only introduced in 2017, was the sustainable minerals. So that's things like lithium and cobalt and that go into batteries and wind farms, and that's the lithium. There was a kind of a lithium bubble around that time, and that's kind of come off, and so that's the way that one's going down. The others are, there's a bit of a much and a muchness. There's a bit of up and down in there. Waste and water kind of go up and down a little bit. Renewable energy has been a pretty sort of steady, slow. It's the sort of lighter blue line running through the middle, and that's been a steady, slow sort of growth. And so we've also seen the market capitalization of those stocks go from, when I started, it was a total of 7 or 8 billion, and it's now I think over 50 billion. So it's kind of grown massively over that time as well. And finally, I'll just touch on green recovery. So lockdown has changed the energy sector, and there's for a number of ways. Many of us are at home most of the week, depending if you're in Melbourne, you're certainly at home. But we've all, even so, I'm in Adelaide. We could come into the office every day, and I come in maybe 2 days a week. The office outside here is pretty empty today. and people. I think that's changed work patterns forever. In some ways, you don't have to be there 9 to 5 every day. So I think that's interesting. That changes how energy is being used. It changes through weekdays, and you can see some figures from March. Yeah, clearly everyone was sort of sitting at home at that point. But some people are coming into the office, so actually offices are going to be powered and homes are going to be powered. So maybe does that increase total energy use? Maybe. Spot prices went down significantly, compared to the prior year. And hardship obviously programs went up. So there's some interesting kind of changes. What will happen when we go back to normal, if there is a new normal? I don't think there is a new normal. So what we'll see is more remote working, more working from home. Some factories changing their schedules or changing or closing. Gas obviously has been a big topic over the last week in the newspapers. I wasn't entirely convinced with some of those announcements, but I think that the global demand for LNG, I think that's not looking quite as powerful as it was maybe a year or two ago, and I think that's going to have some really interesting impacts. We've done some really interesting work recently around EBITDA multiples and kind of the valuation of different businesses in the oil and gas and mining sector, and how they have changed over time, and the cost of debt for those industries, and they're showing some clear signs that the economics of those industries are getting harder. And transport fuels, clearly, people are traveling in different ways. This is probably a bit more complicated than we have time for, but we've kind of identified areas that have high COVID impacts and high climate risk. I'm not quite sure whether there's a green square there. It's not meant to be. But sort of looking at areas where, and these are the most useful for green recovery initiatives. So things like automotive and transport and financial services and oil and gas. And potentially offer the greatest opportunity to start investing green recovery dollars if that's what you wanted to do. And then we kind of have worked through some examples of what you would do in terms of React, Recover, Thrive. And there's a Deloitte report on this, and this is kind of very much taking a global context of what you might want to do in terms of transport and industry and built environment. So I've rattled through that last bit quite quickly, but I wanted to finish up and have some time for questions. So that's a brain dump of all sorts of random things. So please fire away on whatever might be interesting.
Thank you so much, John. And that was absolutely not a random rambling. It was packed with insights. Thank you so much. Some great slides. I do love a good quadrant.
Nice
makes me feel like the word has some cohesive sense.
Yeah.
Thank you so much for everything. There are lots of questions, so I will invite our attendees to unmute themselves and ask directly. So we're gonna start with Andrew. Andrew, can you unmute yourself?
Yeah, sure. Look, Nick, John, firstly, thank you very much for your presentation. Look, your grid, your matrix at the end sort of half answers this question, though I would like to hear your opinion on what do you, like, obviously there's a bit of a risk reward thing going on here. Like, we need a lot of new things to help with climate change. Investing in new things is pretty risky. Most companies want to invest in established things, things where you can drop $1 billion into, and there's things to put it into straight away. Whereas a lot of these things just need to be built. Either the solutions are already there and they need to be scaled up, or they just need to be built to start with, right? So it's really risky. And what are some of the things you think that are most likely to be invested in right now? And how do you think and secondarily that, how do you think that risk reward's going to play out? Because they're going to have to shift their risk reward focus, and can they do that? Sorry, that's probably a few questions.
No, that's right. And what's your definition of they?
Well, any large enterprise. So it could be an investment fund, or it could be BHP. So BHP knows how to invest in $1 billion iron ore mine. They probably don't know how to invest in geothermal.
Yep. No.
To the same scale, right?
Yep, yeah, and I fully agree with that. And I spent nearly 10 years in Origin Energy trying to do innovative things, and finding out that maybe that was harder in a corporate environment than you'd like. So it is challenging, and I mean, there's two thoughts there probably. One is we've actually got all the technology we need, and it's proven, and there's plenty more coming, but there's enough there to solve all the problems we've got, and we've got we've got enough money, and we just need to sort of harness it to the mature technologies. It will all improve, so the new technologies are still needed. So if BHP, and they announced a couple of weeks ago, a very large PPA in Queensland, then they can spend $1 billion. I think there's going to be some interesting changes in certainly the kind of the corporate venture fund has always been a challenging area, and that's effectively where I was trying to work within a corporate is how do you take the balance sheet of a big corporate but actually harness it to do to actually bring through technologies and really drive their growth. When it works, and it doesn't work very often, it can work very effectively, because you've then got you're your own customer. So effectively, you develop the technology and you pilot on your own assets, and you roll it out. There's a really cool scheme in Vancouver where they use city assets to demonstrate emerging clean technologies, and I really like that, because it again enables access to an asset, but also then a market once you've done that. So there's ways there in terms of the change of behaviour. So I don't think the behaviour will change. Where I think things might change is that the level of downside risk is increasing. So that makes it worth being a bit more innovative. So if you're being pressured to decarbonize quickly or to make changes quickly within your business, and the downside of not doing that is investors are going to hammer you, or your share price is going to go down, or something, then there is more incentive to actually take more of a chance on the other side. So I don't think the balance will change. I just think the level of risk pressure might change. So maybe bigger organizations start trying to go a little bit earlier in the cycle on technology. But maybe I am a stubborn optimist, so maybe that's just the stubborn optimist talking.
Thank you, John. Great answer. We have another question from Nick, and I'm going to read it to you because Nick's is in a noisy environment. So Nick's asking, does the increased investor appetite for renewable energy and low emission tech boosts or reduces investment in those clean tech sectors like water, waste, etc., which traditionally were, I guess, seen as turning over smaller returns?
So the increased investor appetite. So yeah, I mean, I guess it's probably not the investor appetite that's driving that. I mean, there's a risk there that if there isn't increasing demand for products and there's increasing investor demand, then there's a risk of having a bubble because the money goes in without actually sort of the fundamental economics being there. I think what's changing things is actually the increasing demand, making those products, a greater demand for those products that therefore makes them have more potential to grow. That therefore brings in the investment that will be successful on the back of it. So I think it's actually the other way around. I don't think the investor appetite to invest into on its own, it actually makes that much of a difference, because you actually have to have a demand there. It makes it easier. It makes the cost of capital cheaper. So a greater supply of capital makes that capital cheaper. So it is easier to finance. So that helps, but it has to be the fundamentals of demand, market demand first.
Thank you, John. Yeah. Now another question on green stimulus. So are we on the verge of a green stimulus boom? A global piece of research led by Credit Suisse ESG branch was recently published, and they found that globally governments have already committed $1.7 trillion US dollars through a green recovery. So investment in renewable energy, energy efficiency, electrification, and transport infrastructure.
Yep.
Do you share this view? Are we heading towards a green boom?
So globally, I think I think that's fair to say. I'm not convinced that Australia is particularly taking advantage of that. And in some ways, it's just if you've decided that you're going to make massive changes over the next decade to all your infrastructure and all the way you operate and your industry and your energy system, and you've got to spend a lot of stimulus money, then why wouldn't you spend it on helping that change anyway? So if you've got both of those things front of mind, then you go, well, it's obvious. If you're not thinking that you're going to, it's a later problem, it's a 2030s, 2040, well beyond when I'm running the country sort of thing, then they're separate problems, and maybe that's so we are seeing it at the state level in Australia. We're seeing some of the states acting pretty hard on that, and trying to focus some of their local stimulus money on that. The federal level probably not so much, and that potentially is a missed opportunity, but certainly globally that's happening.
Thank you. I agree with what you just highlighted. One last question, and then unfortunately we're going to have to wrap up. We've got a question from Alexander. And another from CC. We'll start with Alexander, and then CC, I'll invite you to unmute yourself. Alexander?
Hi, John. I just wanted to check whether there's any managed fund that tracks the clean energy index and that is actually investable in.
Sadly not the Cleantech index, no. I had a very amusing year in 2008 where I went around to every investment company and said, hey, look, you haven't heard of Cleantech, this is going to be huge, we need to set up a fund. And they all said, I've never heard of Cleantech, who are you, go away. And 2008 was possibly a little early, but there isn't a fund that tracks that. It may at some stage happen. There are some funds out there, so some of the Australian ethical investors and some of the others do have some funds that are, not that dissimilar. But nothing tracking that particular index, unfortunately.
Not yet, and you were too early. I agree. Cici, go ahead.
Oh, hi, John. Thanks for an excellent presentation, and thanks, Camille, for organizing this. I guess from my perspective, I'm actually working in the field and helping Cleantech raise capital and finding partners, etc. And I just wanted to ask you, over at a 64,000 feet, looking down to say, have you found an increase in private sector appetite? And do you think that there are actually, corporations and private investors are putting their money where their mouth is? Because everyone is saying that they want to invest in, clean energy, in clean tech, but when it comes to actual investment, I found that for example, if you're recycling coal, they still don't want to look into it because coal is considered as bad, dirty. But met coal is a different story. But recycling met coal, it's still not considered as clean tech, I guess. Yeah.
I mean, depends on your definition, and I think that, particularly on the kind of the coal side of things, there's it comes back to the risk appetite and understanding, kind of transition risk, and whilst there are lots of technologies that work really well, but is the market there? So, but your first question around is there the investment appetite? So, doing lots of work with young clean tech companies over the years is, the best route to commercialization is often actually through partnering with your first customer, or partnering with somebody else in the supply chain with a slightly bigger balance sheet, and then jointly, going and getting money, rather than, the startup trying to. So So there's, and that can be a better route, and there's at least a couple of people on this call who I know have gone that route. There's certainly a lot of sort of, superannuation money and that sort of thing out there wanting to invest in in the $1 billion project. Whoever asked that question earlier, there's still pretty limited funds available for a kind of a venture startup level. The VCs in Australia really, they're more scale up than startup. There is some quite good sort of angel groups and family offices which are backing some early companies, and we're certainly seeing that. And there's even a sort of a couple of them which are backed with old mining money now, sort of looking for the next big thing, and spending some money sort of at the startup level. So it is at the challenge with startup capital, I think, in this sector, as opposed to IT or doing an app, so for 50,000 you can build an app and you can test it, you can take it to market and you can fail and you're done, and that's 50 grand is done. So a lot of clean technologies or clean tech things actually are hardware driven, and so you need 5 million, or if you're a wave farm developer you need 100 million, so before you've really proven the case either way. So the scale of the capital doesn't necessarily fit with the stage of the development. I think where the interesting bit kind of probably more recently over the last few years has been the digital clean tech. So how do you, the demand response type stuff, smart grid, using data to enable decarbonisation or better environmental outcomes. And I think that's kind of the crossover, and it doesn't need the massive $10 million to do the pilot, but it still has material impacts. And so I think it's probably easier to finance those areas than the large capital projects.
Okay, thanks.
Well said, John. Yeah, demand response versus bioenergy, for example, not the same ball game. It's all we have to wrap up. Sorry, it's all that we have time for. So, dear members, I hope this webinar gave you practical knowledge and insights into impact investing and will empower you to make positive decisions. Today was a special day for me because I got to host a leader whose work was a bright and burning spark that fueled my desire to start my own business, Bloom Impact Investing. So thank you, John. John, breaking news. I'm actually an anonymous fan who spent an abnormal amount of time reading each Cleantech Index report issued by your team at Deloitte. So thank you for your work. We won't be in New York for the Climate Week this week, but I think we had a pretty exciting Australian climate party over here today. So thank you again for joining us and generously sharing your expertise with us. And thank you for supporting the sector. Everyone, make sure you register for our coming webinars. Next up, we will dive into quite a different topic, but interesting as well, how to invest for Indigenous prosperity. And I will see you all on the October the 6th. One final thought, we are now 440 members and growing, which warms my heart. That's fantastic, but I would love your help to grow even further. If you enjoyed today, please invite your friends and colleagues who might also find this conversation useful. Make sure you follow us on social media. Finally, I would love to thank you all for coming today and making the time and commitment to learn and be curious. By learning and choosing to support impact investing and sustainable finance, we can truly start creating positive impact at scale. So thank you so much, everyone. Have a wonderful day and see you next time.